Okay, it's early 2001. Enron is the seventh largest company in America. They're Wall Street's darling. And for the year 2000, they're reporting roughly $1 billion in profit. But a young Fortune reporter comes along named Bethany McLean, who's a former Goldman Sachs analyst. She sits down with the company's public filings and cannot seem to answer one basic question. How does this company actually make money? The tell was actually not that hidden. The profits were on paper quarter after quarter going up, but they never seemed to turn in actual cash to the bank. And to top that off, debt seemed to continue to grow. So in March of 2001, she publishes one politely titled article, which is Enron overpriced? And 9 months later, Enron files for one of the largest bankruptcies in American history up to that point. The full story is in the book, The Smartest Guys in the Room. There's documentaries on it. It's totally worth reading about and understanding. But the important part here is that she had no inside information. She had the same 3 financial statements that anyone could have pulled and a checklist for reading them and analyzing them. I want to welcome you to Coffee Chat from OFFERGOBLIN. I'm Michael, and today I'm going to give you that checklist. We're going to be talking about financial statement analysis. Here's why that matters to you. One day soon, a 10K will land in your inbox, a company you'll have never heard of, and you'll have 5 minutes before your MD or principal or VP comes to you and asks the only question that matters: is this a good business? And every bank tests this in interviews. I will pull up a real one later in the episode, and more of these types of questions will be linked in the description. So stick around, because at the end, I will go through the full checklist in sort of a 60-second response to the question, is this company healthy? And how you'd actually say that in an interview. Last session, we covered what the 3 financial statements say. This session will cover more of what they mean. So as we look at financial statement analysis, we're going to break this lesson down into 2 pieces. The first is vocabulary. We're going to go through 10 terms that are going to be critical to understand. We're going to cover them in plain English so you have an intuition for it. And then the second step, we're going to actually go through the process, the step-by-step process of how to analyze financial statements. So let's jump into those vocabulary terms. So first, revenue, top line. That is the top line of the income statement. It's money coming in through the door from customers before any costs get taken out. Net income, that's the bottom line. That's what's left after every cost, including interest and taxes. Margin, that's any profit line in between those two, represented as a percentage of the revenue out of every dollar of sales. How many cents survive to that line? EBIT, that's operating profit. That's what the business actually earns from running itself after all the operating costs, but before interest and tax. That is literally what the letters stand for. It's earnings before interest and tax. EBITDA, that's EBIT's popular cousin. Add back depreciation and amortization, because those are paper charges and not cash out the door, and you get the closest income statement number to the cash the operation generates. It's closest, it's not equal, and you'll need to remember that for financial statement analysis. CapEx, capital expenditure, that's cash spent on equipment, buildings, and other long-lived assets. Free cash flow, the cash the business actually generates after everything it must spend to keep running. That money could genuinely be paid out to anyone or used for any purpose. Working capital, that's cash tied up in running the business day to day. So inventory you paid for, invoices that customers have not paid yet, bills you have not paid yet. Net debt, that's the total amount of debt minus the cash on hand. And finally, revolver. That is the company's credit line. You can think of that as like their credit card. So that is the vocabulary. And now we're going to talk about the checklist. Okay, so step 1 of analysis is going to be on revenue growth. And we're going to have 2 questions there. The first is, how fast is it growing? And the second is that growth real? How do we rate that growth? So how fast is it growing? Well, we have to compare that growth rate to the company's own history as well as its peers. So if a company is currently growing at, let's say, 10% revenue growth per year, but in previous years it had been growing at 30%, that may be a little bit telling to us that growth is slowing down to that business. The other aspect of that is looking at the peers, right? If it's in an area where all the peers are growing at 30, 40% and it's growing at 5%, that may be a little bit alarming. So all of those numbers, we have to look at the context of of that growth as it compares to itself and to its peers. The next thing is looking at quality. So growth from new customers paying full price is durable, but growth from discounting is a little bit borrowed or a little bit more shaky. So if a company grew at 25% because it cut prices and ran all these promotions, those are discounts that are going to be eating into the margin, and the growth stops the day that promotions do. So that's the same 25% growth, but it has different values if one side is mostly customers paying full price versus the other being customers paying discounted price. So the interview version of that is I look at growth rate and growth quality. Where the growth comes from tells me whether it survives. So that is in one step, rate and quality. We need to make sure that the growth that is happening is something that will continue to sustain and will continue to be a part of that business into the future. So revenue only tells you how much comes in the door, and step two will tell you what kind of business this actually is. Step two is the margin ladder. So as you read down the income statement, you're handed three profit lines. That's gross profit, operating profit, and net income. You're going to turn each one into a percentage of the revenue, and that is your ladder. So first of all, gross margin. That's going to be revenue minus the direct cost of making the product as a percentage of revenue. So it answers, can you make money selling this thing at all? And that's pure product economics. Number two is the operating margin. So this is EBIT as a percentage of revenue. And that's going to be profit after all of the costs of running the business. The direct costs plus salaries, rent, marketing, depreciation. That tells you, is this a profitable company or just a profitable product? The net margin then is the bottom line as a percentage of revenue, and that's after interest and taxes. So that answers, what do the owners actually get to keep? So a banker might consider also a fourth rung, which would be an EBITDA margin, and that would be the operating profit with the paper charges added back, like we covered in the vocabulary. And why would you bother with that? Well, two companies can run the same business while owning very different amounts of equipment, and EBITDA strips that accounting difference out, so you can compare the operations head to head. So the latter is the business model written in one column, where the money leaks basically between the top line and the bottom line tells you what kind of business this is. And you always need to ground it, comparing it to peers or its own historical. So you could never compare it to zero. A 3% net margin would be a disaster in software, but it would be a triumph in grocery, for example. There is a free margins guide on OfferGoblin with a full ladder that's in the description, along with a real Evercore Super Day question on this topic that tests exactly this. So kind of two companies with the same margin, different growth. You'll find with a lot of these questions and just in general that the math isn't as hard as being able to actually analyze this and be able to give like a thoughtful opinion about it. And so hopefully as you kind of listen to these podcasts, it gives you a little bit more intuition rather than just knowing how to do the math. Now, there's two traps that I want to cover on this topic. So the first one is that the average margin is just like continued on for each new dollar of revenue. So say the revenue grows by 50 million. The tempting math is to say, well, 50 million times the net margin, which is wrong, because usually the first dollars of revenue have to pay for a lot of the fixed costs, like buildings and teams and things like that. And oftentimes the next 50 mostly does not. So new revenue flows in through at an incremental margin, which is usually much higher than the average, and interviewers can kind of test whether you understand that or not. The other trap is growth versus margin. And this is bait. So the interviewers love this. The company A grows faster, company B earns higher margin. Which one do you want? The trap really is picking one, because the real answer is that it depends on what you pay for each, and that it's really a valuation question wrapped up as a margin question, which is exactly where we'll go next week. But this is step two. So reading the ladder and always against peers. Everything so far is the income statement story, but next we're going to talk about the checks of whether that story is true. Step three is cash conversion. Does profit ever become cash? This is the spine of the whole checklist, and this is the step that caught Enron. Net income is an opinion, cash is a fact. Here's a Super Day question from Bank of America. Why would a company be profitable but have negative cash flow? This is a great question to test your understanding of the cash conversion cycle. Profit and cash run on different clocks. So the net income counts revenue when earned, whereas cash counts when money actually moves. And there's three ways that a profitable company would be burning cash. The first one is receivables, meaning the customers have not paid yet. The second would be inventory, so cash has gone out the door before a sale has taken place. And the last would be CapEx, so the cash for the equipment leaves today, but in full, but the income statement only charges a small slice of it each year as depreciation. So this is the way that a company could be profitable on paper, but bleeding in the bank account. And a follow-up that banks love to ask that trips people up is that, can it go the other way? Can you have losses on paper, but positive cash flow? And the answer is yes. You could have very large depreciation. You could have huge write-downs. That would make you unprofitable, but actually on paper, you have these big increases in cash. So you can see the fully worked answer here on OfferGoblin. You can go into the intuition. You can deep dive into the steps and the math here. We won't drain the slide for this, but check it out. Now watch that exact question play out in the real world. Here is a company that reported $2 billion of profit and lost more than $3 billion of actual cash in the same year. Same company, and both numbers are true. That company is Netflix. In 2019, content spend hit their cash flow statement years before it hit the income statement. And that gap was funded by debt. And today, the model's matured and the free cash flow is strongly positive. Same company, same statements, opposite verdict. And the checklist caught both. That divergence, earnings up, cash not following, debt growing, is exactly what Bethany McLean saw at Enron. When net income and free cash flow diverge for years, something in the model is off. Sometimes it's in the accounting, sometimes it is fraud. The numbers will not tell you which, but they will tell you where to dig. One trap to kill while we are here is that people say EBITDA is basically cash flow. It is not. It is very close. It's not equal. Just remember that, because EBITDA ignores CapEx, working capital, interest, and taxes. Netflix was EBITDA positive this entire time. It was burning cash. That is step 3. So if profitable and cash diverge for years, then that's a place to dig. So the business makes money and the money is real. But the next question is, who has first claim on it? Step 4 is leverage. And that's how much debt the company carries relative to what it earns. So a quick question, when a company earns $1 of cash flow, can I, the owner of the business, just take that money out? Of course not. The lenders need to get paid first, and the debt holders always eat first every single time. So leverage tells me how much of the actual cash flow is already spoken for before any of the owners see a dime. And it comes down to one number, net debt over EBITDA. That's roughly how many years of earnings it would take to pay off all of the debt. As a rule of thumb, 1 to 2 times is conservative, and 4 times plus would be pretty aggressive. So with Enron, the entire earnings story was funded by debt. So as that began to unravel, the shareholders were really left with very little, perhaps nothing at all, as the lenders were able to collect on the cash before them. So that one ratio really gives us a sense of how much claims the actual owners of the business have on that free cash flow. So leverage is kind of this longer run question, but the last step that we'll talk about is the short run question, which is, can you pay your bills now in this term? Okay, finally, step number 5, liquidity. Can the company cover the next 12 months? Because this is how a company actually dies. It's not from a bad quarter. It's not from thin margins. It's not from people at the company being really annoying and you having terrible coworkers. It's from the bills that come due when there's no cash to pay it. That is the event. So the check is pretty simple. It's the cash on hand plus the revolver against whatever comes due within the next year. Liquidity is whether a company can survive a bad year. Everything else in this checklist is really more about whether it can thrive in a good one. And that brings us to this last way that candidates get tripped up in interviews. The belief that positive net income means that the company is healthy. That is the assumption this entire episode is meant to dismantle, and hopefully you're not going to fall for that. That profit can be real on paper while the cash drains, debt piles up, and in 1 minute, you can see the entire company fall down as it's unable to pay one payment or a handful of payments. And in just a minute here, I'm going to put together the whole checklist in a 60-second answer as I promised. Because here is the thing about analysis questions. They are verdict tests. The interviewer is not grading really the ratio and the math so much as your ability to move numbers and make judgments and say those things cleanly. So the checklist, just to review it once again, was the growth, the margins, cash conversion, leverage, and liquidity. And now, before we get into this last closure, I'm going to give you some homework, and that is the Moelis Super Day case that's linked in the description. They're going to hand you 2 consumer company income statements in percentage of revenue terms, 5 years, and ask you which one you would rather own. The card walks the exact framework for breaking that down. You can read it and pull up 2 real consumer companies and run that checklist yourself. That is the rep that will make this stick. So link in the description and go to OfferGoblin to check that out. So finally, we get down to this last piece. What happens when you get this 10K on your desk? Okay, cold conference room on a super day. The MD walks in, slaps a 10K down on the table. He gives you 5 minutes and says, report back on the health of this business or get the fuck out of here, dude. Here's how you're going to do that in 5 steps. First, revenue. How fast is the business growing, and is that growth durable? Because if this top line is weak or fading, everything underneath it is fighting uphill. Weak revenue is going to be the first sign of a sick business. Number 2, margin ladder. That's 3 numbers. The first one is gross margin. That's what's left after making and selling the product. The second is operating margin. That's what's left after running the business. And finally, net margin, which is what's left for the owners. Together, they tell you how much of the top line the business actually keeps, and healthy companies will keep more of that than their competitors. Sick ones will leak it on the way down. Third is cash. Put free cash flow next to net income. If the profit keeps showing up, but cash never does, the earnings are not real yet. And that is how companies look healthy right up until they aren't. Fourth is leverage. That's net debt over EBITDA. Debt holders get paid first, so the higher that number, the more of the cash flow is already claimed, and the less room this company has to survive a single bad year. And fifth, liquidity. Cash plus the revolver against everything that comes due in the next 12 months, because this is the one that actually kills the company. The other 4 are trends, and this one is an event. A bill comes due, and if the cash is not there, it is over for this business. The margins do not save you. The growth story does not save you. Nothing on the income statement saves you if you cannot pay your debt holders. So those are the 5 steps in 60 seconds and how you can defend your verdict on any company that anyone would hand you. So that is the episode. And by the way, that checklist is basically what Bethany McLean would have ran on Enron. It's what other financial analysts would run on any other publicly traded company. The 10Ks are public filings, and this is a simple framework you can use to assess the health of a business. Every question that I mentioned today is from an actual bank. There's questions from Evercore, Bank of America, Moelis, Barclays, in real reported interview questions. You can view the full worked answers on OfferGoblin. There's going to be a bunch of links in the description. If you want the reps, that is where they live. If this helped you, please like and subscribe. We're doing new episodes every Friday. Next week, enterprise value versus equity value, what a company actually costs, and can't wait to see you then.